What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. We've got our core list of companies that we're always watching, and this week I've got 4 additional trade ideas to share with you towards the end of the video, so definitely stay tuned for that. As always, anything we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. Kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, there's no way around it. This is certainly a bearish inverted hammer candle here, a nasty upper wick, certainly indicating that we have selling pressure at the highs, which pushed prices back down to the opening print, through the opening print, and we closed extremely weak down on the lows of this week's session. Certainly not going to read into that minuscule lower wick. So from a structural standpoint, bears have full control. From a location standpoint, we'll find the same thing. Notice that we have an outside bar, so a week-to-week higher high, but also a week-to-week significant lower low here. And at one point in time, you have to reimagine that this was a solid-bodied green candle, and we were looking like we were starting to resolve this pullback back to the upside. Everything was fine and dandy. Maybe we would reattempt the top end of the range here. Obviously, that wasn't the case. Instead, the sellers step up in a big manner and shut off all of the buying activity, again, lending back to structure. We did close extremely weak down on the lows of this week's session. So the bears are in control, the sellers are in control from both perspectives there. If we scrunch up the weekly time frame chart, remember in the past we were tying in pattern as well. Our initial head and shoulders looked something like this with a neckline that was horizontal, closer to 425. That was no longer in play once we made the equal, potentially higher high in here around that 460 mark, but you can start to draw in a new head and shoulders pattern, and it has a slightly different look, something that would be like this. And the reason I bring this up is because your neckline entry point technically is a trend line. It's a moving target. It's not necessarily just a boring static horizontal level. So do I think the head and shoulders is going to be in play this upcoming week? Not really. Remembering that, for this to be in play, we would have to have a weekly bar close underneath that neckline. I think it would be quite difficult for the market to put in a range that looks like this. This is the most comparable candle we have to something that might mirror that type of expansion of range. And I do think that just coming into these horizontal supports here might provide a little bit of a hang up for the marketplace. So I'm not expecting the head and shoulders pattern to be in play this upcoming week, but it is something to continue to monitor for here on the larger timeframes. Instead, what I would say about the weekly timeframe is that for a majority of 2022, we've been stuck in a sideways range with relatively equal lows, a couple of instances in here, and clearly equal highs up at the top of the balance. So we've really just been playing this ping pong game back and forth. I would imagine that we do want to come back down and test the bottom end of the range. And then as with all trading, the question of course has to be, do we hold here for a bit of a dead cat bounce, or do we break on down and finally get out of this range that we've been stuck in for the better part of 2022? So those are my thoughts. We would clearly have to reevaluate the chart, how we arrived at the bottom end of the range, right? Because context is always so important, and then make that decision when and if the time ultimately comes. But I do think a likely scenario for this week could be putting in a bar that at least comes down and tests those lows around 415 from a weekly perspective. So with that being said, let's drill down to the daily time frame here and start talking about tradable levels into the upcoming week. The first thing that you can clearly notice about our daily time frame is a violation of the support trend line, as well as this horizontal area here coming from prior resistance. If you make pretend and extend that to the left with me as well, it was also support from in here, and even further from around in here as well. So the market and the selling hasn't really cared too much about our technical levels, and I think it's really obvious if we just remove this and actually drop it down to a 30-minute time frame that this is not panic selling. This is algorithmic selling. This is large institutional type selling. A panic sell day would look something like this, where it's one large red bar, or maybe it's two large red bars to the downside, and then you get sideways consolidation towards the end of the day, right? Usually the damage is done done in the first hour or two of trading, and then after that you kind of cool off into the afternoon. But notice what's been going on the past Thursday and Friday session, where it's just controlled, sustained selling. We come up, we tag. It's not just a big free fall to the downside. Now, granted, it is serious selling. I'm not sort of trying to diminish its seriousness, but it's not panic selling. And that's an important distinction to make, because you never try to quote unquote catch the falling knife when it's not panic selling. Usually a panic sell has a little bit of a reprieve bounce and you can play for that dead cat. But when you notice it's controlled and sustained selling like this, it's usually not a good idea to try to catch some sort of a bottom. So I did want to offer that up as some advice for what we've been seeing over the past 2 days of trading. Obviously an increase in volume as this has been taking place as well, which is an important thing to note here. So what do we have on the docket going forward? Again, we have closed underneath this prior critical area of support, which, it was resistance. We just walked through that level, right? So it would be expected that we do see some continuation to the downside here and get into those lows from early March, late February, right? This is obviously that invasion panic day low. That's kind of going to be the line in the sand, but this is going to tell us a lot about the marketplace at 417.50. If we come in and we start to bounce, then technically speaking, it is very nuanced here. It would be still a higher low from the panic invasion day, right? And if that happens, then maybe the market's not as weak as we think. But if we just, break right through that, again, we see more of that algorithmic type selling and we move right to here, that's where things start to open up for more of that bearish scenario of breaking out of the range that we've established so far for the year of 2022. So those are really my main focuses for the upcoming week here. Again, it does look like, based on the nature and the seriousness of the selling that's been going on here, that we will get some follow through to the downside. I'll point something out on the internal screen in just a moment that might say maybe there's a chance of a dead cat bounce coming. We'll talk about that in just a second here, but certainly the selling pressure is real. Notice also that both of our short trade setups have been fulfilled. So we had the look above and fail. Target's always the bottom end of the range. We hit that in the course of one day, right? And then the next setup is, of course, when you break out of a range, you look for that range to double. And that would have roughly taken us right to this level that we had mapped out. That trade has also been fulfilled here to the downside. So I wouldn't really recommend chasing it short here. I would wait for at least some sort of intraday setup where you can, really use tighter risk. If you're a swing trader, I don't really think here's the time to chase it. So those are my thoughts to the downside. And again, the numbers to pay attention to down here, 417.50, and then your low of the invasion panic day is 410.65. Let's just speculate that there's some sort of massive turnaround and we start to retrace a majority of Friday's activity. I would be very, very mindful of the bottom end of balance here at 437, noting it was also the neckline of our double bottom right here. So any sort of retracements back into that level, my first thought when and if we arrive there would be to search for short patterns and say, okay, we're getting a break and retest. Let's see if we can find a short with tight risk. Stop goes just above, and you're looking for that rollover off of that level. So that's what I would say about the upside. If we accept back into this range, then my goodness, what a wacky market we will be in. We would have to reassess, again, the context of how that move is established, if it's established in the first place. A couple of Fibonacci things that we're going to take a look at before we move into the sectors and take a deeper look at those internals. If we come from the low of here up to the high, clearly underneath that 61.8, which again increases the odds that you get the 100% retracement. Even if we come in from that panic low up to the high, again, you're underneath your 61.8, which was conveniently coinciding with this. So nonetheless, a bearish look from both of those Fibonacci perspectives. And then if we scrunch up the chart and come from the all-time high back down to that low, notice again that we're firmly underneath the 38.2 here, which puts us back in bear territory. Remember, this is bear territory. This is more neutral in between the meat of the fibs, and this is back to bulls. Again, it would be the exact opposite of what we just discussed here for the round trip. You would be looking for that 100% retracement to the upside. Obviously, that's not in play. I'm just talking through the Fibonacci scenarios, right? So that's what we have here in our S&P 500. Let's quickly take a look at our sector ratio charts. The big four up at the top are ultimately in the driver's seat of the marketplace. You can see that tech continues to be weak. It started to look like it was showing some bottoming activity, but obviously into the end of the week that was obliterated. So this is still weak here in tech. This is still starting to turn back over for the pullback in the XLV healthcare. The only thing that looks okay, semi-okay, is the XLY. And we know that was a majority of that work was done by the positive Tesla earnings, even though Tesla faded off from earnings, closed the gap. We'll get into that that when we get to the core list of companies, but just, discussing the XLY there, a little bit of relative strength, but it might be deceiving, right? If Tesla breaks down from its balance, which we'll look at in just a moment. And then the XLF pointing back to the downside, that chart's fairly concerning on the daily as well. If we look at our risk off sectors, which are the small four down here at the bottom, notice that they all continue to look phenomenal, which is ultimately what we don't want to see. Notice your XLP continues to point to the upward direction, really gunning for blue skies there. XLE cooling off, but still well above a upward sloping 50 SMA. Same thing here in real estate, gunning for those blue skies, and utilities just hovering nicely again above an upward 50 SMA there. I think we should take a look at some of the candle charts themselves, just to note that if the market's going to continue to sell off, again, look at consumer staples. It was extremely relatively strong, right? And if this starts to pull back in a more serious way and we do not see ourselves catch in the XLK or some of those heavier weighted sectors, then when all of the sectors are moving in unison to the downside, obviously that's where you get those really nasty days. So noting that these are coming from highs and do have room to pull back and still be reasonable, that's sort of a scary thought, right? Noting that if the XLK doesn't catch a bid in some of these more aggressive risk off sectors, which have been, really looking good, start to see that pullback, again, that's a recipe for disaster. When everything's red, obviously there's no shot that your S&P is going to hold up or even go sideways. So with that being said, let's quickly flip through them. XLP starting to pull back. I wouldn't be surprised if it comes in for the test of 78 and the prior high in here, which is coinciding, which means, again, more red for your S&P 500. Utilities, same deal, breaking down out of a flag up here. If this pulls in, your target could be around 72, so more downside in utilities. Real estate coming back down into this range right here. If that's a look above and fail, we know the target should be closer to 48, right? So building the case that even if the sectors that did look good on the ratio chart start to, deteriorate a little bit, it's really not going to be a good thing for our S&P 500. XLY, again, sitting right on a flush point here. If this is to break down like we've already seen in the SPY, look at the range and distance that this can travel before it finds next support, all the way down there around 162. So, sectors are not looking hot. I mean, obviously, XLC continuing to fall off of a cliff, no support whatsoever at the 64. Not a good sign. Even if this catches a dead cat bounce, if we resist here and roll back over, that's still a bearish development, right? XLE for energy, what's going on here? Failed breakout. If this one comes down, I could easily see it coming back down closer to this level here, around 70, the bottom end of this most recent ascending triangle, right? A failure there might take us to the prior breakout point. Again, more red for your S&P 500. XLI, not really a big portion of the S&P, but flirting with this shelf of support. We know that it's not really the end of the world here. This is such a lightweight sector. XLK, though, this one, really important, coming into that critical support. If this starts to break down before your S&P breaks down, maybe it's an advanced warning that, hey, we're probably at least going to those lows, if not through them, in the upcoming week. If it does get a little bit of a dead cat bounce, that might be a little bit of a saving grace in the early part of the week for the S&P 500. So watch that 142 like a hawk here inside of your XLK. Financials, again, this one is fairly concerning. This one really caught my attention. Remember that in the midweek market update, we were discussing that we wanted to see from this equal high right here, either a higher high be made or a higher low pullback for something that built out as an inverted head and shoulders. Obviously, that's not the case anymore. And we even took out that low from around in here mid-April, right? So this certainly big drag on the S&P 500 continuing to deteriorate. We would look at it in the macro now and say we're just continuing to put in lower high after lower high. The expectation is that we would come into 3550, which again is more drag, downward pressure for the S&P 500. XLV is up next, breaking that support trend line, breaking this horizontal critical area that we were discussing in the midweek market update around 137. I mean, this is not a good look either, right? So things are not really pointing to positive developments for our S&P 500 based on the sectors, even if this turns around. Just like communications, we talked about the backtest. If we form a lower high here, then we start to build something out that looks like this. New downtrend is certainly in play inside of healthcare. And this one was like a relative strength monster for a while, at least in the big four. And now it's just kind of right back down on par with things showing weakness. Last but not least, we do have the builders. Not a huge deal for our S&P 500, but at least worth talking about. breaking down from this flag, right? We're still going to probably fall into this chop zone. It's such a lightweight sector. I'm not overly concerned with that, but obviously any red pressure in the sectors is, downward pressure for your SPY. So that was a quick run through of the sectors themselves, both the ratio charts and the structure. I do want to point out, I suppose we'll take a look at the VIX before we get over to those market internals and why I think that there might be the possibility for a small dead cat bounce early on in the week. But before we do that, again, VIX here, volatility index, fear index, perking right back up, right? So we did not get any acceptance back down underneath this 2050 floor. This just means that it's going to be more difficult for people to feel comfortable about getting back into the market, which we should sort of expect as we've seen an aggressive pullback. So it's not like the VIX is kind of still hovering down here as the sell-off's happening. There is, although not via price action, there is some fear, and I want to say this lightly because I talked about it not being there, but some panic in the marketplace. Just the fact that people aren't, comfortable getting back into the marketplace is all I'm getting at. So although, yes, algorithmic selling, the VIX would indicate some fear in the marketplace, all right? So anyways, getting over to the internals and why there could be the potential for a small dead cat bounce early on in the week. Let's just walk through it. Obviously, some serious outflows in the market on the Thursday and Friday session. Usually our benchmark is 300 million, whether it's positive or negative, and we clearly breached that and some on both of those daily sessions. If we look at the advanced decline line, again, look at the activity here. We opened well above, almost in trend zone on the Thursday morning session, and to fall all the way to the opposite end of the spectrum, that's a big deal. That's a hefty amount of selling pressure sustained across the entire New York Stock Exchange. So there's really no love out there in the marketplace. But this guy right here, bottom right-hand corner of our advanced decliner, is what's telling me that, hey, maybe things are a little bit too oversold. It's very rare that you stay down here underneath negative 2,000 for a sustained period of time without any sort of reprieve. And as we saw with the sectors, everything was red as measured from yesterday's close or today's open, Friday's open. You get the gist. So if money needs to rotate somewhere to start off the week, then maybe we do see a little bit of a dead cat bounce. But again, based on the severity of these internals, I wouldn't overstay your welcome on the long side. Let's take a quick look at the cumulative ticks just to see what's kind of going on there. Again, very significant reads on both of those sessions there. Basically, even if we just zoom in on the bars here, notice that all of the activity is basically underneath the zero line. There was only one or maybe two bars that closed above the zero line on the Friday session. So really the selling out there, guys, is serious. And this again strikes me as much more algorithmic as opposed to panic driven. So with all of that being said, hopefully you can see why we're building the case that this pullback is no longer a pullback. We should be expecting lows in here. And granted, the only time that we're going to be bullish is for either a quick dead cat bounce early on in the week. Another really good potential setup for this is if on Monday morning we actually open on a gap down. I would say that because inventory is skewed so heavily to the short side, we should look for that gap to fill. And obviously we'll discuss those scenarios on the pre-market live stream into the upcoming week, but that's something to focus on as well, right? The inventory is starting to skew towards oversold. Maybe we get a little bit of a dead cat bounce, which again, we've walked through all of the evidence that continues to point to lower, but there's the possibility in the short term that we are a little bit oversold, right? So that's what I've got for you as an in-depth S&P analysis here. Let's continue along, get into the QQQ NASDAQ 100. Of course, we're going to have a very similar look. Something I would continue to point out here is the relative weakness. Notice that this never made it for the look above and fail. Instead, it stayed completely contained within the range. It broke down before the S&P. Notice that we get the close underneath on the Thursday session instead of inside, and then we continue on the Friday session. Again, it's very, or the target at least is very obvious here around this 318. That's where it looks like the market wants to go. We have plenty of balance overhead, so this supply up here is plentiful. It's not like we're going to run out of longs that are going to be closing out of their position to continue to apply selling pressure here for the lack of follow through to 318. It looks likely that we do see that follow through based on a number of disappointed longs who did not get paid throughout this period of balance, right? So let's quickly take out the Fibonacci's and do sort of the same deal that we did in the SPY. Again, it's going to be very obvious that we are now firmly underneath the 61.8 here. That was the bottom end, the shelf of support. So more than likely that we do get that 100% retracement. And if we come in from, let's do it from both the lower high to here. I mean, obviously well underneath that 38.2. So if we come from the higher one, it's clearly going to be even further underneath, but nonetheless, just, really accepting into that bear territory instead of potentially poking back up into the more of the neutral section of our Fibonacci. So everything about the charts do point to lower right now, but be aware that early on in the week, especially if we open on the gap down, that there is potential for a little bit of a dead cat bounce corrective activity to the overly net short inventory. On turnarounds here in the QQQ, again, this is going to be critical resistance back to the upside. The bottom end of the range will act as resistance now for a break retest, so be mindful of 335 up to roughly 338.33. It's a little bit sloppy in there. Let's see if we can see anything a little bit more nuanced on the 30 minute. Not really. Again, here's your low that would tie in closer to the 335. There's some equal highs up here on the open of Friday and the close of Thursday, so I would probably watch for 335 first, and if it does poke above that, I'm still not confident in longs until we can start putting in higher lows above 338.33. Okay, so that's how I would use those two levels, and just what that might look like is something like this. Okay, fine, higher confidence long, but if we do something like this and kind of struggle in this area, that's where I would say, okay, we're really looking at the break and retest for a short opportunity to come back down and revisit 318, all right? Anything that accepts back into the range would require a reevaluation of the chart, just noting the significance of the sell side activity and the strength of the selling that we've seen here. Again, just to wrap it up in the two big ones, be mindful. If we do get a gap down, a little bit of corrective activity could be in store. So I don't want you to get overly bearish based on what I'm saying and get some sort of rip your face off snapback early on in the week. Just be mindful of the inventory correction. All right. That's all I would say there. IWM, last but not least, to round out the broad market, small caps here. What do we see? A more firm and definitive break of our support trend line here. Obviously, you get the look above and fail. We fulfilled that. And we are also coming in. Let's just quickly measure. I'll zoom in a little bit more for this. Let's quickly measure to see if we've gotten a range double here. Not quite, but very, very close. So for all intents and purposes, I would say both of those short trades have reached their targets. We can get rid of the support trend line, of course, that's no longer in force. We are kind of trying to, or not trying to, but we've closed right on this horizontal area of support. So this one might be a candidate where you say, all right, if we do something like this, then this is just an obvious flush point, right? So anything that consolidates above puts in a nice little bear flag here. That's where you're looking for the breakdown. If we open underneath the level, again, on a gap down, I would look for a correction and then resistance off of that at 193.50 instead of looking for the bottom end of the range way up there at 196.68. Remembering that IWM is more of a sort of risk on, risk off indicator. This is clearly just right in its range, right? As we were discussing on the SPY Weekly, we have a range. IWM has been a little bit more obvious here because of this activity that we had in there. But nonetheless, bottom end of it could certainly be in play for the upcoming week. Ideally, to see the marketplace maybe stabilize, we want to see small caps remain in the range. So catch support around 188, and maybe we'll get some more ping pong into the early parts of the summer. But for now, again, there's no way around it. All of these charts do look bearish. So enough on the broad market. Let's get into these individual companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. Kicking off our companies here with Apple, we do have earnings around the corner here, so do be mindful of that. Obviously, a bearish breakdown of our support level around 163.50, and we have quite the ways to fall to the bottom end here around 152.20. We do have a 200 SMA, which has not been tested in quite some time. So if we do come in for the test, maybe that offers some support, but I wouldn't place a whole lot of faith in that level all by itself. Remember, a 200 SMA is just a line on the chart, whereas some of our levels are coming from prior structure, right? So be mindful of that. Let's quickly go down to a 30-minute time frame. What I want to illustrate here is that 167 is still critical resistance. Even if we get a little bit of a dead cat bounce, nothing bullish happens until we recapture that level. You can see how many times we've interacted with it here. Of course, it was the lower high on the way down there, struggling around this area. And look at what happens on the Friday morning session. We try to resolve it. Remember that this upper wick would indicate some buying pressure on the smaller time frames, like a 5-minute, but there was no acceptance above that level. So to me, even if we get some activity in here, I'm neutral on Apple. I'm not bullish. The only bullish activity in Apple is a higher low above 167. But as we saw on the daily, it does look like lower is more likely than higher, right? So that's Apple. We're going to kind of move quickly here since we spent a long time on the broad market this week. Netflix still strikes me as dead money. Obviously, two really big earnings gap downs. Money's flowing out. It continues to do so. You have a 3-day flush point in play. If we just grab the other tool quickly, you're looking for continued shorts and weakness down underneath 210. And the only long trade is a little bit of a squeeze up and over 228.13. We can see this on a smaller time frame with multiple rejections. I know the chart's skewed. It's really ugly because of this gap. But if I do something like this, you can see, boom, big shelf of resistance. Didn't quite make it there on the Friday morning session. But nonetheless, if we can take that out, really thin structure, right? So maybe there's a long trade to be had on some break of 228. But currently, the look is bearish, and a break of the 3-day flush point could continue to push us lower here in Netflix. Anyways, Tesla is up next. What do we see here? This is what I was talking about with the XLY, consumer discretionary. Obviously, we got the gap up, but it faded all day on the Thursday session. We are accepting back inside of this balance on the daily time frame as of Friday with a little bit of an indecisive doji here. The flush point is obviously underneath 980 roughly, and if it breaks, we're looking for 945. Remember, the importance of 945 is this prior breakout point from right around in here. I still do think that that's a critical area, especially if the 50 SMA is going to tie in for a super support. Any breakdowns, I would not be looking to initiate new shorts around here. That's where I'm actually looking for potential reversals inside of Tesla specifically, noting the importance of this prior structure in here. So that's my first area of intrigue. And then after that, it would of course have to be the rising support trend line, just noting that Tesla, it's not currently close to these lows from in here, right? So it still isn't an uptrend. We did make a higher high, so pulling back into the support trend line this time around should be potentially a buy if we see the structure support it, right? So if we start to get hammers down here, if we see intraday bottoming patterns, then that's where I would look for the long. Obviously, if Tesla just wants to come in with nasty red candles, you're not going to try to catch the falling knife at the support trend line, right? So it's all about context there, but I would be monitoring that. To the upside, if we do get a reversal, any acceptance back outside of this balance, so over 1022, strikes me as being tradable, at least in the intermediate, but the better longs in Tesla at this point in time, noting that we failed a couple of times to get out of this balance, are really just over the resistance trend line. I mean, if we can reattempt this, like something like this, obviously we have a higher low there, and that would be a little bit more attractive for a breakout back up towards those all-time highs around 1250, right? That's much longer term thinking, but those are some of the levels that I'm paying attention to during this week's worth of trade. AMD is up next, and what do we see here? Continued weakness, no doubt about it. A long time ago, it's really not that long ago, but we did identify this on the weekly. We've talked about it, right? The head and shoulders pattern there. We're clearly underneath the neckline at that psychological 100 mark. We did see a number of failed break and retests here for lower. We closed weak on the Friday session underneath the low end of balance. It looks more than likely that we do continue this downward descent. 85 roughly is the next area of support. Anything interesting on the 30-minute I can show you? Not really here. The only thing I guess I could point out is that early on the Friday session, notice that there wasn't even enough strength in the marketplace to come in for a retest of the breakdown point at 92.50. So again, AMD's been relatively weak. We know that it did not rally like NVIDIA did, even though NVIDIA's back down at the lows. This one never really got out of its own way in this section of the chart here. So continue to look for weakness inside of AMD. Facebook, again, this one's kind of falling into the camp of what's going on with Netflix. So we'll see what ultimately happens with earnings. To me, I would prefer that this did not see another massive gap down like what we saw in here. If it does happen, then we'll have to deal with that when it comes. But for now, we're sitting right on support. We are technically underneath that level at 185.85, but nonetheless, I would watch to see, can we get a bit of a dead cat bounce, or are we just going to continue down underneath? So I wouldn't be trading this. I wouldn't be chasing it to the short side early on this week. And instead, the trade to watch for essentially in Facebook is if it is lower out of the gates on Monday, that's fine. You're looking for shorts against this level for the break and retest, right? Your better entry is here, tight risk above, looking for the equal low as your target there. That's how I would approach this to the short side, noting that you don't want to chase this now that we've been down significantly 3 days in a row and are coming into critical support. So if this does if this does start to break down, again, I wouldn't chase it here, noting that if you get something like this, you're easily going to get stopped out of that, right? So be mindful of that here inside of Facebook. The better trade, as I've pointed out, is a break and retest, and then we can go from there. The long trade, if you believe it is going to be long, is okay, can we get back above that level first of all early on in the week? And then if so, can we start producing higher lows above it? Anything that's above this area in here is a little bit more convincing. Again, tight risk here. Your stop has to go underneath that low, and you're probably looking for a retracement back up to the scene of the crime, quote unquote scene of the crime, up there around 210. All right, so that's what you would have to look for to make that trade worth it. Again, with earnings coming up, I'm not sure I would want to risk holding a short duration option through that particular event. So that's Facebook in a nutshell. And by the way, guys, I think what we'll do, since Netflix is kind of in dead money land, we'll replace that with Google once the split takes place. We'll just continue to keep tabs on Netflix, but I don't really think it's too tradable as of right now. Next up is NVIDIA. What do we have in NVIDIA? Obviously, as we pointed out, for a number of prior videos, we had seen significant enough consolidation here where we're okay with taking breakdowns after the 100% retracement. You can go back and watch midweek market updates, prior weekly watch list videos. We've seen enough consolidation. We're ready to go with the breakdowns here. And obviously that's what we're getting into the latter half of this week. Again, just like we talked about in Facebook, a conservative short trader might look for a backtest of this zone here around 209 up to 211.50, stop over the highs, looking for a move back down towards the equal low here. That's if we get a bounce out of the gates. If we continue lower, I'm not sure I would want to chase it down here, noting that we're coming into support at 190 up next. Scrunching up the chart, you can see shelf from in here. After that, we have 155.50. So guys, even if this does come into 190, it's not the end of the world. There still is plenty of range to be trading for to the short side down here. Don't feel like you're missing out if you don't get it around this 190. Wait, be patient. Again, we've been down aggressively 3 days. If we get a dead cat bounce, again, that's your sign. If we never make it here in the first place, that's a clear lower high. There's a number of new short entries that we could get around this 190 that would open up that next range to the downside. My fear is that we do get a little bit of corrective activity to the inventory to backtest this, and you don't want to jump the gun on the short, okay? So that's my main concern with many of these charts that have broken down from their ranges. So that's what we see there. To be more confident for longs, again, it's got to be a higher low back above for a look below and fail. Doesn't strike me as something that's likely early on in the week, but we'll take it in stride. Next up, we have Microsoft. What's going on in Softy? First day of the breakdown of the balance area right here. So again, expecting the equal lows around 271.50. It's really not that far away. Earnings are around the corner on this one, so be mindful of that. If this whole thing breaks down, so if we get a move underneath this, if it's before earnings, right? So your next support underneath is coming in at 261. Where's that coming from? Let me actually grab a couple more years here just so you can get a little bit more of the picture. If we zoom in, prior resistance, little resistance in there. Notice how we go sideways and then it breaks. That level is yet to be retested. So 261 strikes me as important if we start breaking down underneath 271. So about a 10-point range, right? For upside trades, because this one hasn't really seen too much follow through underneath the bottom end of balance, this could possibly turn into a look below and fail sooner than other companies if in the first place we see any sort of uptick early on in the week. So be mindful of that. That Microsoft might be one of the ones that you want to watch for if the broad market starts turning around to the upside. Again, we've pointed to a number of things that would indicate lower, but something to be mindful of, right? We're always open to scenarios in the marketplace. So that's what we've got there. Amazon, last but not least, the beast. Let me drop this back down to a yearly so we're not looking at a ton of data. What you can see here, again, is just a breakdown of your prior balance area there. We don't really have too much structure until we come into this gap from back here around 28.20. So that would be my target. Again, earnings are a little bit further out on this one, so you can trade it early on in the week. And then after that, equal lows are the big deal around 27.10. We'll call it 2700. That's ultimately your round trip here inside of Amazon. In a majority of everything that we've seen so far, we clearly know we're underneath the 61.8, but let's just quickly check in on Amazon. Yeah, look at that. Clearly underneath the 61.8 here, instead of like obviously NVIDIA, right? That obviously consolidated and already broke. So pointing out that we are in bear territory here inside of Amazon from a fib perspective. Just like everything else, any upticks here, look for backtests of your 3000 for resistance, rollover, tight stop just above. You need to see some sort of inverted hammer, bearish intraday pattern. That gets me interested in shorts at those areas. For convicted longs, just like everything else, higher, low, above. Maybe that shifts the narrative, but it doesn't look like a likely scenario as of right now. So let's move along into these ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's get right into these trade ideas. First one is on AAPL. And what I want to point out here is the relative strength. Look at the 2 days of balance. So inside bar on Friday. up at the highs instead of weak, kind of, falling out of a balance area that's more akin to here for a move lower. So relative strength in the airline sector, even if we take a look at the ETF jets, so here we go. You can see that, this is a conglomerate of many airline industries. And what you'll notice, again, same thing. There's relative strength here. It's not just a select pocket of strength in American Airlines specifically. But what I'm getting at is any pullbacks here. So if the market does continue to fall, I'm really interested in the backtest of this level where we've had a number of prior interactions, roughly around 19. So if AAL wants to break the double bottom lows early on in the week and move into 19, I am on the lookout for any sort of break and retest at that level, right? Something that does this gets interesting for the return back up for the equal high around 21. So a 2-point move on something that's, trading roughly around 20 certainly is worth your time, right? And if you do it with options, it's definitely worth it, right? You can load up. These are probably fairly cheap. If we come on over here, look at what we have for the weeklies, really, really cheap, under $1 for the ones at the money. If we go out in time, these things are really reasonable, right? So this is definitely something that you could load up on if we get a retest of 19 for some sort of bounce. Don't get me wrong. Just like we discussed in Tesla, if it comes through there with big red-bodied candles, you're not trying to catch the falling knife. But if we do come in and we start printing a hammer candle, if we start seeing indecision dojis around this area, just the selling pressure really subside, then maybe it's a long back over the highs for the retracement up here with a tight stop just underneath, right? So that's what I would watch out for in American Airlines. Uber is up next. What do we see here? Currently, more of a similar look to some of the other tech companies we've seen, breaking down from the balance. But notice that's a very close break to the bottom end of balance at 31.12, 31 even. I would look for more significant follow through in this one too. The bottoms in here around 28.61, noting that this has just begun to break down instead of fairly, outside of the range already. So Uber looking for some more follow through to the downside. Again, any sort of consolidation that doesn't really get into gear above 31 strikes me as bearish. Looking for follow through. Stop can go just above that. Note also that the trend is your friend here inside of Uber. This has been on a downtrend clearly for quite some time, whereas in something like Apple, it's obviously a much stronger stock, a much stronger company, right? So the trend is your friend, downside is more easy in Uber. That's what we've got there. Marvel is up next. This is, of course, in the chip and semiconductor space, right? Breaking down underneath the balance lows. Again, there's your bear flag, bear balance, whatever you want to call it. First day of breakdown, looking for some more follow through. A day trade here could be into 56.89, call it 57 if you like nice round numbers. And that, of course, is coming from prior structure in here where we had support. So that's, again, your first target. Anything underneath, you're probably looking at this level. Let's just map it in together so we have it roughly 53. All right, so that's what we've got there. And again, just like in our Uber trade, your stop goes just above here, looking for the follow through, not on the day trade, but if you're trying to swing trade this into the bottom at 53, then again, stop here, entry kind of around here, makes sense for roughly 2 to 1, 1.5 to 1 risk reward ratio, move stop to break even as soon as possible. Next up, we've got CHWY, and again, very similar. This one is more of a descending triangle, though. If we do something like that, you can roughly see there's your triangle pattern. First day of breakdown on the Friday session, looking for a move into 30 even. So currently from 34.50, obviously easy math there, $4.50 to the downside is available. If we quickly take a look at a larger time frame, just so you can see where that structure is coming from, it was prior resistance, which then offered support as we started to build this new uptrend in here. So that would be my structural target to the downside. Again, that is 30. After that, there's some more significant room to fall closer to 22.32, but one step at a time, right? Let's not get ahead of ourselves here inside of CHWY. Just like Uber, I would also say that the trend is your friend here, and we've clearly been downtrending for longer than something like your Apple, your Tesla, your NVDA, right? Microsoft, those companies. So that's what I've got for you for trade ideas. If you enjoyed the video today or learned anything new, let me know in the comments section or by giving the video a thumbs up. If you would subscribe to the channel, I would appreciate that. And with all of that being said, I wish you a green trading week.